Okay, welcome to this live webinar event. The topic we're going to cover is inflation. So we're going to really understand how we can protect our wealth in a rising price environment. Now, before we get started, let me introduce ourselves. So my name is Gavin Panu. I'm an advisor and wealth planner. I've had a decade worth of experience as a trader and analyst. And I bring some of that institutional knowledge to give my clients the insights that they would need to be able to develop their financial plans, look after their investments and funds, and ensure that they have the right protections in place. And the firm that I represent is Tradenomic Financial. We are a boutique financial advice firm. We offer bespoke and personalized financial solutions to our clients, but also applying institutional methods to really give them advanced portfolio management. And we are based in the UK, London. We have two office locations, one in West London and one in Central London. In Central London, we're based at 30 Lombard Street, so we're about 2 minutes walk from the Bank of England itself. And we are also located in West London, Zone 6, in an area called West Drayton. Okay, let's get into the topic ahead. So what we're going to cover is, as I mentioned, inflation. But before we really go into some of the key trends that we've seen over the last 6 months to a few years, let's really understand what does inflation mean, right? So look at the definition and explain that a little bit further of what measure we use to really define inflation. So inflation is the rate at which the general level of prices of goods and services rise, and how it has an impact on eroding purchasing power over that time period. And the key measure that we use to really monitor inflation is the Consumer Price Index. Now, what that shows us is a measure which is used to gauge inflation by tracking the average change over time in the price of a basket of goods and services. And so this is the latest figure. So this is taking the July figure, July of 2023. And what we can quite clearly see is that prior to 2021, we were in a period of a low inflation environment. And inflation generally stayed around the 2% marks in this region here. Yeah. Now, a key point to mention is that the Bank of England want to maintain inflation at the 2% mark. They want to keep inflation at 2%. Now, they will take action if it goes above or if it stays quite weak and significantly lower, right? But generally, they are happy to keep inflation around the 2% mark. And you can see most of these years from 2017 through to 2020, we were just above or sometimes slightly below, but the Bank of England were pretty much happy with where inflation has been over those years. And then what we can see is during 2020, early part of 2020, this was sort of the key eventful period of where we had a pandemic, right? So we had COVID taking place in February, March of 2020. Now, during that period, of course, we've not seen a pandemic as large of a scale as we have over the last 100 years. So what we saw took place is two elements: monetary policy and fiscal policy, all having an impact at the same time. Yeah. So monetary policy is related to the Bank of England and the steps that they take to ensure that the consumer environment and the economic conditions maintain an adequate level. Fiscal policy is looking at it from a governmental perspective. So how are governments incentivizing consumers and businesses and individuals in this economic environment? When COVID took place, we saw both measures really stepping up. both monetary and fiscal measures. And what that did was that put in an injection of a lot of cash and a lot of support measures being put into place. And that's what really started off inflation started to really trend in a certain direction as it has, right? So going into the latter part of 2021, we really saw an outburst of an inflationary trend. What that means is if there's a lot of cash running through the oils of the wheels in the monetary system, in the economic environment, that would have an impact on those goods and services also rising in prices. Okay, and that's what we saw, is that knock-on impact taking place into those goods and services. Now, what we don't want to see is that continues to trend higher and higher and higher and gets to a point where it could cause a systemic failure, right? So if we see a high inflation taking place, that would have a knock-on impact on consumers. And that's where we had the term, the cost of living crisis taking place, right? So while all these goods and services that we're seeing is rising significantly, we're not seeing that being also having an impact when it comes to wage growth. So, and at that time, we had a lot of individuals that were unable to work due to the circumstances that had taken place around COVID. So that's where the cost of living crisis came into play. Now, focusing on the Bank of England specifically, it was down to the Bank of England to really take the right steps to start to tame inflation, right? And that's what we wanted to sort of see is how far will inflation rise and when will it start to fall? And fortunately, up until now, coming into August of 2023, we have seen the peak taking place in inflation. So reaching almost around the 11% mark, or just shy of the 11% mark, right? And then since then, we have fallen down to around 6.8% in regards to inflation. Now, it's a huge improvement, but it's not over yet. We still want inflation to reach at least below the 5% mark, okay? Now, where previously the environment has been keeping inflation around the 2% mark, will we get back down to 2%? It could take a little bit longer than expected, but getting to a 2 to 5% range or 2 to 4% range is a very, very positive sign for the economic environment. So there are two areas of concern at this moment, okay? We've seen energy prices fall. So for example, oil prices had reached a peak of 136 in the height of everything that took place over the pandemic. Since then, it's fallen and it's trending around the 80. It's trading around the $80 mark, or slightly above the $80 mark, from 136 to $80. So that those energy impact that we had seen in the price of oil at petrol stations and are not the same as it was at the height of that. So there has been improvements from an energy standpoint. We've also seen food prices most recently in the last couple of months. We've seen food prices have now started to fall also, which also did go up significantly for a little while. So there has been some improvements, but there's two key areas that have come into focus at this moment. One is core inflation. So that excludes food and energy. That is still at a high, even though we've seen a little bit of a dip, but we're not seeing that move in a downtrend where you start to see markets form lower lows and lower highs in regards to that measure. At the same time, there's been a peak in services inflation as well. So now we're seeing wages are now starting to step up and services are going up in price. Think about insurance policies, so car insurance policies, home insurance policies, they're reaching significant highs at this current moment when it comes to quotations. So these two areas are of a concern at this moment, even though we've seen some improvements from other areas, such as I mentioned, food and energy. So what are the Bank of England forecasting going forward? So firstly, their forecasts are suggesting that inflation is going to be close to 5% by the end of 2023. So we'll need to see in the upcoming months, in the remaining months of this year, do we go on to get to that 5% mark, right? Being at 6.8% at this current moment. So we're looking for a fall of 5%, but then you can also see that their forecasts go into up until 2025. So they're seeing that by 2025, middle of 2025, maybe a little bit later, you could see we reach back to that 2% mark. So we're going to likely to see a downtrend, but it's going to take some time. It's going to take up until 2025 based on these projections from the Bank of England. Now, as I mentioned, that the Bank of England needed to take action. What action did they take? Well, for them to ensure or maintain and bring down inflation, they need to raise interest rates. And that's what they did over the last year and a half. Okay. In fact, out of the G7 countries, the UK were the first to raise rates when inflation was exceeding their mandates. In addition to that, they have taken 14 almost consecutive, I believe so, 14 rate hikes since then in a very short period of time. And you could just see that by just looking at this chart here. Now, again, this was sourced from the Bank of England. You're looking at BBC as well on the 3rd of August, 2023. And we can see where rates have been previously and where they are now, right? So the last time we saw rates at these elevated levels were before the global financial crisis of 2008 and 9, right? So we're back to those levels. And if you look at in between, so after the GFC, the global financial crisis, I mean, you can see where rates were, right? Rates stayed at these levels for many, many years. So, and these are accommodative levels, right? If we're looking at interest rates, there's two factors to the interest rates, right? One is for the borrower, one is for the saver, right? So now, or the investor, saver or investor, right? So from a saver investor perspective, a low inflationary environment such as this, which is sort of, between this point and this point, right? Yeah. This period over here, yeah, they're not going to be receiving a lot of interest from their savings account. So they need to take a little bit more risk by making sure that they are investing to achieve the highest yield possible. Yeah. And that's for the saver and investor sort of side of things, right? For a borrower, an environment like this is great because I can borrow money from the bank and pay very little interest towards it. Yeah. So this environment makes it a little bit more difficult for savers investors, but it's a great environment for borrowers who can want to build a business or expand their business or invest in property or whatever it might be, right? So it's a great environment for borrowers. But now we've flipped almost now the fact that we've seen almost 14 consecutive rate hikes, taking us back to 2007, 2008 levels of around 5.25%. Bank of England are also suggesting that they may raise rates another 2 more times. So we could see rates somewhere between 5.5% up to 6%, depending on the increment of the rate amount that they take in the upcoming Bank of England rate decision meetings. So, yes, so now that that's flipped, what's taking place right now is in the shortest time period. So looking at this period up until sort of where we are now, looking at this environment here. Now, in this environment, what's happening? Now it's flipped. So for borrowers, it's become difficult for them to borrow because there'll be less banks looking to give out to lend. There'll be less banks lending because of the rate, the purely because on two factors there. So the first will be is the speed that the rate has risen. They need to catch up. They might think, hang on, let me just wait till the next meeting or the following meeting, or and that's why we saw a lot of mortgage products had been taken off the shelf for some time, right? So borrowing in this environment becomes more difficult. And of course, when you do secure some borrowing and some capital that you can borrow, you're paying a much higher interest rate also, right? And looking at one of the key areas is, of course, the mortgage market. And with the mortgage market, where base rates are around 5.5% in this region, your interest rate could be at 6, 7, 8, 9% cost to you. And that could have a lot of impact on consumers and individuals and businesses who are looking to expand or buy a property or whatever it might be. Yeah. So it's flipped in that way, where it's become a more difficult environment for borrowers or for companies and businesses who are looking to expand. And that's why we've seen a lot of these businesses that are looking at ways of maybe reducing the workforce, if applicable, looking to maximize their profit margins by making reductions in sort of, on those areas. So they're trying to make themselves a little bit more efficient in this environment. So coming over to savers and investors, this is a good environment for savers and investors, right? Because now you don't need to entirely rely on the stock market, which is allocated at a higher risk, because you're taking risk to be invested in these and take ownership in these publicly listed companies, for example. What you can do is reduce your risk level by achieving a 4, 5, 6% return on a savings account, right, which has less risk involved. Right? So now a saver investor can reduce their risk level, and they have a lot more opportunities by not just being invested in the stock market to receive the return that they would like, but they can balance that with bonds and savings accounts as well. So just to showcase, I'm not going to spend too much time on this, but just to showcase the global hiking cycle, what this is showing us is the pivot that we had seen from the pandemic to where we are now. So you can quite clearly see that during the pandemic, that's where we saw monetary easing taking place, right? A lot of monetary easing. And that's what I mentioned. Monetary easing and fiscal policies all coming into play, making it a very accommodative period of time in this region here. But that really caused inflation to get out of control. And we saw a lot of advanced economies and emerging markets quickly snapping that back and becoming a lot and going into monetary tightening. Yeah. And that's what this showcases here. And as I mentioned, we've seen rate hikes, and they've been risen in at the fastest rate in any other time in recent history. Okay, so in this image, we're focusing mostly on the US central bank, the Federal Reserve, right, and their rate hikes. But you can quite clearly see that's the trajectory of that rate hike, with how long it lasted. Whereas look at all these other dates that we have when we're looking at 2004 to 2006, you're looking at 99 to 2000, 94 to 95, 88 to 89, 2015, 2018. So yeah, so these periods, right, all predate what's just happened in the last couple of years. But this is going in the history books as the fastest that we've seen rates going to these elevated levels in the shortest period of time. Okay, so how do we go against hedging against inflation? Okay, so how do we mitigate risk and really sort of, manage our wealth correctly, right? Well, we'll start with what we don't want to do, right? So, what is the areas that we want to ensure that we don't do? Well, the first thing I'll probably say is large amounts of cash holdings. That's one area that's an area that you don't want to be just sitting there on large sums of cash. which probably may not be receiving the best levels of interest rates. But at the same time, the inflation is eroding its power. If the cost of goods and services are continuing to rise on a not just an annual basis, could be on a quarterly and monthly basis, what you don't want to do is hold loads of cash that is being devalued over the years, right? Because £100,000 in a cash account will not be £100,000 5 years from now, right? You might have £100,000 5 years from now, but what it can buy, if you compare it from now to and in 5 years' time, it's going to be two different things. It's only going to be able to afford goods and services at a smaller amount than it did at this current moment. So that's what you've got to balance out. Is what we recommend is to have cash holdings, but have cash holdings of your as an emergency fund, right? So to ensure that any short-term unforeseen circumstances that arise, you've got the cash surplus that's required for that, right? And then ensure that you have other protection measures in place, whether it's a protection policy or an insurance policy that could cover you and provide the coverage for you and your family in those unforeseen circumstances as well. Yeah. And the second thing that I've noted is the amount of individuals that are still in their current bank accounts and are not switching to a much better performing, yielding banking account, right? So it was noted in a recent article that we had put onto our website at tradenomic.co.uk, there is a substantial amount of billions of pounds that are sitting in 0% savings accounts or current accounts, right? And you need to be able to use that money and put it to work. Have your money work for you. So look to switch over to a current account that's giving you a much better interest rate. Yeah. So those are sort of the two elements that I would say that you should not be sitting in a bank account that's yielding 0%, and you shouldn't be holding large sums of money. Now, what can you do to counter that now? What are sort of the areas that would allow you to hedge against inflation? Well, it requires you to, the whole point is if inflation is these elevated levels, right? Let's say it's at 6%. What I want to do is I want to ensure that my money earns 6% in that year, right? I want to achieve 6% or better to outlast or outbeat inflation. That's the idea. Now, to do that, you do need to take some level of risk. And that is where equity markets is one good area that you could look into. So these are investing in companies and taking certain ownership through the shares that you purchase of that company. And if that company continues to do well in this current environment and continues to make a profit, you will earn a dividend, and the share appreciation and the growth in the share value is also something that you benefit from. In a inflation period where currencies are eroding, the purchasing power of currencies is eroding, the best hedge against that is to go to something that has some scarcity to it and is seen as a safe haven, and that would be gold. Also, real estate. Real estate also performs really well in these economic conditions as well. But it does also depend on supply and demand levels. But overall, real estate is a good hedge against inflation. Emerging markets as well. So if you are looking to, especially if you're looking to really beat inflation and you want to achieve a return of 8, 9, 10, 12%, then you need to have some exposure to emerging markets, which do have double-digit returns in some cases. So that needs to be balanced out as well, as to have that where there is higher risk involved, but also there is a great amount of return that's associated with that as well. And then this is a great environment to be in the bond markets as well. So for many years, the bond markets provided very little return and very little yield on an ongoing basis. But now that's not the case. We're seeing certainly bond markets, the yields might be rising, and that's great, right? But bond values are falling. There's that inverse correlation in the bond yield and the coupon itself, the bond value. So it might be a great time if you're looking to focus on the yield and earner and interest on an ongoing basis. The bond market is a great place to be involved at this moment. But the strategies and portfolio adjustments that you need to make on an ongoing basis, and one thing you should note now is ensure that you're diversified, right? You no longer need to be in one area, right? You can go and hedge against inflation and achieve a good return, but you need to have the right level of diversification, right? That ensures that if there's one area of the market that doesn't perform well, then as you're diversified into other areas, they could make up the losses that you may have made in that one area, and give you potentially a larger return, a higher return. So diversification, as they say, is your only free lunch when it comes to investing. It does help to mitigate single exposed risks involved. Yep. Invest in assets with pricing power, right? So just remember that holding cash, because cost of goods and services are rising, and your cash is not earning anything, but those goods and services are rising, right? Your money is being eroded over that time. So you want to be in assets that are appreciating according to inflation levels. And as I mentioned, we spoke about emerging markets, and just having international exposure can really bring a significant benefit to your overall portfolio. So when it comes to planning, and we're going to look at 3 different scenarios. So these will be 3 different strategies that you could take advantage of in these inflationary periods that we're in, whether inflation is high, moderate, or low. Okay, so we don't know what's going to take place, even though we've got forecasts from the Bank of England. But I want to be prepared for all environments, in all conditions. So if we see a new rise in inflation levels, and inflation, had formed a low and it's starting to rise and go back to those elevated levels, right? What you may need to now consider is becoming a little bit more aggressive to those hedging options, right? I want to allocate a larger portion of the portfolio into those hedged options that I've covered with you. This will really allow you to really focus on achieving growth in the right way, and to not allow your capital to erode due to inflation. But if we see moderate inflation, which means that inflation stays where it is, it starts to drop a little, and it just stays balanced and it moves sideways, as we've seen it in history, right? Being around the 2% mark for some time. It might stay around the 5% mark for some time. We don't quite know. But if that's the case, right, then you need to have a balanced approach, right? So that's where diversification is going to be key to how you manage your portfolio in that environment. And then when there is a low inflation period, which means that we do go back down to the 2% or lower, right, then the focus should be on growth. So in that environment, as I mentioned, that's where borrowing becomes a lot more easier, when interest rates starts to fall again, and we start to see that there'll be companies looking to expand and grow. So growth should be the focus then. Focus on maybe growth companies and growth sectors that will do really well in a low inflation environment. But you do need to maintain some level of hedging, right? So diversification should be always in whatever scenario that may take place. But the portion of diversification, or a percentage of asset allocation in those diversified areas, will be dependent of that scenario. Okay, that's it from me. So thank you for joining me in this session. I will end the recording here. If you're looking to book a discovery meeting with us, you can call us directly at on 0203 376 0575, or you can head over to our website at tradenomic.co.uk. And if you head over to discovery meeting, you can book one in directly into our scheduling app. Yep. And yeah, we'll end the recording and we'll take some Q&A. We'll do a Q&A round and really sort of, see if we can give you some great insights at this moment. But thank you for joining this session so far.